Let's look at the largest cryptocurrency on the market. We're going to examine if the foundation of this industry is actually built to last, or if we're looking at a deeply unstable structure. To do this right, we need to completely ignore the internet memes and community hype. Instead, we're going to run a strict, data-driven economic stress test. This animated diagram breaks down the asset's original 2008 white paper. That document promised a peer-to-peer electronic cash system. To test it can achieve that goal, we measure it against three pillars: a medium of exchange, a store of value, and a unit of account. Economists rely on these criteria to define real money. A currency must hit every mark to work. If an asset cannot pass these three tests, it fails as a currency, period. So let's look straight at the raw data to see how it performs. Step 1 of our stress test is the medium of exchange. We need to evaluate the network's speed and operational cost to see if it can handle daily payments for the general public. This split-screen chart illustrates the data. On the left, Bitcoin processes 500,000 transactions per day. On the right, Visa processes 65,000 every second. The traditional network clears crypto's daily volume in 8 seconds. Speed is only half the equation here. We also have to calculate the physical electricity required to process a single trade on this network. This graphic shows that a single digital transaction consumes the same amount of power as the average American household uses over 43 days. Because the network is heavily energy-intensive and slow, it actively prevents people from making efficient daily purchases. It fails the first requirement of a medium of exchange. Step 2 is the store of value test. We're checking if you can hold this asset today and spend it years from now without losing your purchasing power. This line chart tracks the asset's historical price volatility. As you can see by these massive vertical spikes and drops, it regularly swings up to 20% in a single month. This instability means businesses cannot rely on it as a secure savings vehicle. This pie chart reveals the cause. Ownership is heavily concentrated, with just 2% of addresses controlling 95% of the supply. This top-heavy structure allows large holders to manipulate markets, like one firm allegedly wiping out $40 billion in 2022. When an asset is at the mercy of a few large holders capable of triggering massive crashes, it fails as a secure store of value. Step 3 is the unit of account test. To see what happens when an entire economy attempts to price goods and services in this digital asset, we can look directly at El Salvador. In 2021, the government declared it legal tender. They launched a national digital wallet and gave every citizen $30 worth of free crypto to encourage them to participate. The local population rejected the mandate. Protesters took to the streets demanding annulment, calling out the technology as a source of corruption and scams. This funnel graphic tracks the user retention from that initiative. While millions initially signed up, the data shows a 60% drop-off rate. Users downloaded the app, cashed out their $30 bonus, and abandoned the platform entirely. According to tracking data from the International Monetary Fund, less than 2% of El Salvador's international money transfers were actually processed using the asset. Even with a government mandate and a direct financial bribe, citizens chose to stick with the traditional financial system. The real-world experiment failed, meaning the asset fails the final unit of account test. The asset fails as a medium of exchange, a store of value, and unit of account. This creates a massive gap between its total lack of utility and its high market price. Economists explain this gap using a concept called the greater fool theory. Without generating cash flows or producing physical goods, the asset's value relies entirely on the expectation that someone else will buy it from you later for a higher price. This flowchart illustrates exactly how the machine operates. Carefully crafted narratives generate hype. That hype attracts new buyers, which artificially drives up the price. The rising price generates more hype, and the loop continues until the pool of new buyers eventually dries up. Here is the final summary checklist of our diagnostic. Feel free to screenshot this list to save for your own due diligence. The asset is too slow, requires too much energy, is highly centralized, failed real-world adoption, and relies entirely on the greater fool theory. Now it's your turn. Take this exact 3-step diagnostic framework and apply it directly to your favorite alternative crypto project. Run the numbers and let me know in the comments below if it passes or fails.